Hello, good morning. It's Thursday, June 20th morning, where we almost come in and look at the screens and say, wow. We had the FOMC meeting last night, and the signals following that is almost to buy everything apart from the dollar. The Fed basically dropped his patient approach to rates going forward, and the market took that as an open invitation to jump into bonds, get out the dollar, get into stocks, get into gold. We're going to take some of the charts just to take you through some of the major events since yesterday. Starting off with this one, you can see the expectation now for a rate cut this July has surged basically to 100%, and the split between those looking for one cut is and those looking for two is 75 to 25%, and we have really seen a phenomenal turnaround in markets over the past few weeks here into June. May was where the policy panic started to emerge, and now June is where we're starting to see some of that being delivered. Staying with the chart, we can see some of the performances across the different asset markets. Something like semiconductor, which were the big drop off in April and May, they are now up 8% so far this month. But generally, we got gains across the board with the risk appetite coming back into the market, in the belief that the Fed will come to the rescue, the dollar will weaken, and that will provide some overall support. Looking at the stock markets, they did react as well. The Nasdaq, as I'm showing here, is once again approaching the record highs. And the question being asked is really, has the Fed ever cut rates with stocks at all-time highs? They have, in fact, a couple of times, both in 89 and 95, and a couple of other occasions the market was within 5% of the all-time high. So this is not anything that's going to prevent the Fed from reacting. One of the big movers as well was the currency markets. Even though we have not seen the market break out, apart from the yen, there was general dollar selling across the board. And taking a look at the chart here, we can see dollar yen is the one that's probably at this stage attracting most attention because of the collapse in yield spread between the two currencies, basically removing some of the dollar support. So dollar yen is trading near the low. If we start to remove that spike we had at the beginning of the year, we are starting to get into some thin air where we could see some further weakness. What's also driving this is the speculative positioning. The table here or the chart here on the right is giving you an idea about the speculative interest based on currency futures, and we have seen the market starting to smell a bit of a dollar weakness in recent weeks, but the net dollar long, which is the blue line at the top, is still is still near the highest level since 2015. So that is leading to some short covering, from which the yen has been quite a bit of a beneficiary recently. It also raised the questions about the currency war is coming back on the radar. We saw a Trump tweet the other day, and just looking at the chart here, he basically came out blasting at the ECB's Draghi's comments about the euro dollar. You can see this chart from the Sober Look on Twitter, that we had these two reactions in the market in euro dollars recently, where we got the ECB talking about rate cuts and now Fed talking about rate cuts. But overall, it looks like Trump is gearing up his rhetoric against his currency. He wants to see the dollar weaker ahead of the 2020 election. And for the market at this stage, with the uncertainty and the weakness we have in growth, the numbers, a weaker dollar will to a certain extent provide some support. It will support the US exports. It will also support emerging market growth, where obviously the huge debt pile of dollars is going to ease some of the pressure if we both see rates come down and we see the value of the dollar come down at the same time. And I think overall also the Trump's re-election hopes next year stands probably a better chance if he goes into that with a weaker dollar than we have today. Looking at the bond market, 10-year yields dropped below 2%. It's now the lowest since November 2016. Even the market is now starting to talk about a 1% 10-year yields, but obviously that depends on how much the market will panic and how much the growth outlook continues to deteriorate over the coming months. But at least the market is a very, very strong momentum there right now, driving it higher. Staying with the charts, what could go wrong at this stage? Well, I think that this one gives us the best example of that. Really, the market is now has extended its views on rate cuts over the coming 6 to 12 months, to the extent that if there is any change in incoming data, the market could find itself in being in the wrong position, and a sharp change in that in the short-term outlook could have an impact across the board. But you can see right now the orange line, which is the expectation for Fed funds 12 months out. We're now expecting a rate cut of more than 1% over the next 12 months. Obviously, should it deliver a 50 basis point cut already this July, there's plenty of time for the additional 50 basis point and potentially even more than that. So at this stage, the market is not prepared to book profits on any of these long trades in some of these short-term futures where they're looking for lower rates. Commodity markets reacted as well, gold the most, and finally we're having a decent attempt now to break higher. This is the strongest attempt for gold to break since 2014. In one sweep yesterday we took out three trend lines, and we stopped short at the highs from 2014, just peaked through, but came back down again. But with the current momentum in the market, and with the expectation for rates, then the market the recent established longs will not feel that nervous at this stage. Probably the key level now to look for downside is that trend line. If we stay above the mid 50s level, I think there's a good chance we will eventually push higher. From a technical perspective, and that's probably what a lot of people are looking for, if we start to break this 2014 high, the next really big level in terms of resistance is $100 higher. So that's really what's also attracting some attention into gold. And apologize for the chart being hidden by the logo, but we basically just stopped short there at the top blue line. In other commodities, crude oil has moved higher as well. Combination of several things. Right now, if you look at WTI, which I've put on the chart here, we are breaking higher this morning. Brent is still $1 or so away from breaking out of its recent range, but overall, the drop in U.S. inventories yesterday, which is the top right chart, you can see for change, we had a seasonal move which was it was in line with the seasonal developments. That was quite a bit of relief to the market. Gasoline demand is at the highest for this time of year on record. This is just showing the 4-week average, but if you look at the week-on-week change, it was close approaching 10 million barrels used a day. But additional to the support right now is the OPEC finally agreeing on a date, and they are going to discuss an extension into the second half. And this morning also, the key reason for the jump over the last half an hour or so has been news from the Gulf that Iran has attacked, shot down a U.S. drone, which apparently or allegedly was in international waters. So that has once again returned attention to the focus to the geopolitical risks. And then finally, the FOMC decision yesterday, a weaker dollar is overall good for commodities, as we also saw for gold. Plenty of things to digest this morning. The calendar is going to give you plenty of time to do that, because it looks pretty light. The only thing that we have coming up, as far as I can see, in terms of important, is the UK, it's the Bank of England's rate decision at 11 GMT. But otherwise, clearly the day will be the market contemplating and digesting the yesterday's decision to remove that patient statement. And you can see how the market was really just looking for any kind of sign that the Fed was going to do as the market was telling them to do. And now obviously we need to see over the coming months whether the Fed wants to deliver. But for now, the market is clearly in the belief that they will deliver, and potentially even more than, or at this stage, more than what the Fed is indicating that they're prepared to do. So stay tuned to this. It's going to be an interesting day to follow. I will be back again the same time tomorrow. Thank you.